Noah, were you surprised by what the Fed did here, or was this kind of your expectation ahead of hearing Jay Powell say, forget it, 75 basis points not on the table right now?
Yeah, I'm. There's been so much rhetoric since the last meeting, intra-meeting from Fed governors coming out, some former Fed governor talking about bringing down the stock market as to tighten financial conditions. And so the market got really carried away with 75 basis points. That still means we're starting QT, and we have at least 250 basis point hikes coming. I think the reality, though, is that if you look at the overall market, you've had an enormous move in Treasury yields year to date and mortgage rates. I mean, mortgage rates are up almost 70% year to date. I know it doesn't happen on a quote machine on your desk, tick by tick, second by second, but there's no way that a 70% move in mortgage rates isn't going to have an impact. Real estate has a much longer lag than stocks. And so, the Fed does have to sort of be careful. There's a lot of tightening that's already occurred, especially given how far mortgage rates moved. And, in the relative asset game, mortgages and housing has a much larger and significant impact on the overall economy. So, dialing it back a little bit is not unwarranted, and being a little more data dependent is certainly not unwarranted at all.
Have you been a buyer with the market? I mean, we've moved pretty significantly over the last several days. You saw 900 points plus yesterday. That was third day in a row of gains for the markets, but it really just got us back to last Thursday, as Mike Santoli pointed out. Have you been a buyer on the dips that we've seen the last several weeks?
Yeah, I mean, look, I'm a growth investor, so it's been a very tough market since November. As soon as the macro took over, growth stocks have been pummeled here. And so, the S&P 500 is still about 7% off of where it was on the March highs when the 75 basis point talk went around and former governors were talking about bringing down the stock market. So, I think we can rally back to there for sure. Depends if that brings out another governor to talk the market down. I think overall, though, we've had two mad jobs reports, and we're just beginning to see the effects of some of these rates moving through the economy. When I look at growth stocks, though, today, on a relative valuation multiple, they're at some of the lowest levels they've been since 1980. And so I think that's, it's obviously an area I focus on. I hear the analogies of NASDAQ 2000 from some bears out there, and I get the emails making that analogy. I was running the same fund I'm running now back then, and many of the people emailing me were in grade 6 at the time. And so, Facebook's at almost the same P multiple as Altria, formerly Philip Morris. That wasn't the case in the year 2000. And so our analogies right now on how bad the markets have been are 2008, worst NASDAQ start since 2001, worst month for NASDAQ since 2008, worst month for the S&P since the pandemic, and sentiment is awful and terrible. So there are a lot of catalysts for a move higher for sure. And we've passed, typically when we've passed peak inflation, it's been good for the markets. And March was probably peak inflation.